There's a legal trick that lets CEOs steal from their own companies, and it's destroying the economy. It's called stock buybacks, and until 1982, it was illegal, considered market manipulation, stock fraud. Then Reagan changed the rules. And what happened next is the greatest wealth transfer from workers to executives in American history. In 2023 alone, companies spent $800 billion buying back their own stock. That's more than they spent on research and development, more than they spent on worker wages increases, more than they invested in growth. And here's what's criminal. Buybacks don't create value. They don't build anything. They don't hire anyone. They don't innovate. They just artificially inflate stock prices. And executives get rich from stock options, while workers get nothing. This is the story of how one regulatory change, in 1982, broke American capitalism, how it turned CEOs from company builders into financial manipulators, and how buybacks created the illusion of growth, while the real economy stagnated. Stay with me, because what you're about to learn will make you see the stock market completely differently. And it'll explain why worker wages haven't grown while CEO pay exploded 1,000% plus. The market isn't rising because the economy is strong. It's rising because companies are buying their own stock with money that should be going to workers and innovation. Let's start with what stock buybacks actually are, because most people don't understand the mechanism. A stock buyback is when a company uses its cash to buy its own shares from the stock market. The shares are then retired or held as treasury stock. Example: Apple has 16 billion shares outstanding. They spend $90 billion buying back 500 million shares. Now they have 15.5 billion shares. Seems harmless, right? Companies just buying its own stock. But here's what happens mathematically. Before buyback, company value $2 trillion. Shares 16 billion, price per share $125 after buyback. Company value still $2 trillion. Nothing actually changed. Shares 15.5 billion, price per share $129. The stock price goes up 3%, not because the company is more valuable, but because there are fewer shares dividing the same value. It's like taking a pie and cutting it into 8 slices instead of 10. Each slice is bigger, but there's the same amount of pie. Now here's where it gets criminal. Most CEO compensation isn't stock options. Their pay depends on stock price. So when a CEO does a buyback, stock price rises artificially. CEOs' stock options become more valuable. CEO gets massive bonus. CEO sells their shares at inflated price. CEO gets rich. The CEO didn't build anything, didn't create value, didn't grow the business, just manipulated the stock price. This is why buybacks were illegal until 1982. They were considered a form of stock manipulation and market fraud. Let me show you the history. 1920s, 1970s. Buybacks are legal but heavily restricted. SEC considers them suspicious. Courts sometimes prosecute them as manipulation. 1982. SEC passes Rule 10b-18 under Reagan administration. This creates a safe harbor for buybacks. As long as companies follow certain rules, buybacks can't be prosecuted as manipulation. The rules are: don't buy more than 25% of average daily volume. Don't buy at the opening or closing of trading. Use a single broker per day. Don't buy at a price higher than the current highest bid. That's it. Follow these simple rules, and you can legally manipulate your stock price. Result: buybacks explode. 1980s, $150 billion in buybacks for the decade. 1990s, $500 billion. 2000s, $2.5 trillion to 010 South. $5 trillion 2022-2023, $3 trillion. Companies are spending trillions buying their own stock instead of investing in workers, research, or growth. And CEOs are getting obscenely rich from it. 1982. Average CEO makes 42x worker pay. 2023. Average CEO makes 350x worker pay. What changed? Buybacks. CEOs now optimize for stock price instead of company health, because that's what makes them rich. But it gets worse, because buybacks don't just enrich CEOs, they actively harm everyone else. Here's what happens to a company that prioritizes buybacks over investment. Case study: IBM 1990s. IBM is a tech leader, investing heavily in R&D, creating new products, hiring engineers, growing. 2000s. IBM starts massive buyback program, spends $125 billion on buybacks over 10 years. That's $125 billion that could have funded R&D for new products, higher worker wages, new factories and facilities, expansion into new markets. Instead, it went to inflating stock price. Result: IBM falls behind. Loses tech leadership to companies like Amazon, Google, Microsoft. Those companies invested in growth, while IBM bought back stock. By 2020, IBM's revenue is lower than it was in 2010. They're stagnant, declining, a shadow of what they were. But the CEO who ran the buyback program, he made $250 plus million from stock options. He got rich while destroying the company's future. Case study: Boeing 2010 to 2019. Boeing spends $43 billion on buybacks, more than they spend on R&D for new planes. This is insane. Boeing is an engineering company. They need constant innovation, new designs, safety improvements. Instead, they're buying back stock. 2019, 737 MAX crashes, twice, killing 346 people. Investigation reveals Boeing cut corners on safety to reduce costs. Why? Because every dollar spent on safety is a dollar not available for buybacks. Buybacks created pressure to cut costs everywhere, including safety-critical systems. The crashes are partly caused by buyback culture, prioritizing stock price over engineering excellence. Boeing's stock crashes. Company faces $20 billion in fines and settlements. Reputation destroyed. But the executives who ran the buyback program already cashed out, already rich. Case study: General Electric, 2015 to 2018. GE spends $40 billion on buybacks, while the company is actually struggling. They're using borrowed money for buybacks, going into debt to buy stock. Why? CEO compensation tied to stock price. Buybacks boost stock price. CEO gets rich. 2018, GE nearly collapses. Reveals massive accounting fraud. Stock crashes 75%. Investors lose hundreds of billions. But the CEO who ran the buyback program made $200 plus million before the crash. Pattern emerging. Buybacks make executives rich while destroying companies. But it's not just individual companies. Buybacks are distorting the entire economy. Here's the macro problem with buybacks. They're creating a false economy. Look at the stock market. S&P 500 has tripled since 2009. Everyone says the economy is booming. But is it? GDP growth: 2 to 3% annually. Mediocre wage growth: 1 to 2% annually, barely keeping up with inflation. Productivity growth slowing. Business formation: declining. R&D spending as percent of revenue flat or declining. The real economy isn't booming. So why is the stock market? Buybacks. Since 2009, companies have spent $7 trillion on buybacks. This money flows into stock market, inflating prices artificially. The market isn't rising because companies are more valuable. It's rising because companies are buying their own stock. This creates massive problems. Problem 1. Misallocation of capital. $800 billion spent on buybacks in 2023 is $800 billion not spent on research and development, new factories and equipment, worker training and education, higher wages, new products and services. This money is wasted on financial manipulation instead of real investment. Economic growth requires investment in productivity. Buybacks are the opposite. They extract value instead of creating it. Problem 2. Inequality explosion. Buybacks transfer wealth from workers to shareholders and executives. Workers create value through labor. That value becomes profit. That profit should be shared between workers' wages, shareholders' dividends, company reinvestment. But with buybacks, profit flows almost entirely to shareholders and executives. Workers get nothing. This is why worker wages stagnate while productivity rises. CEO pay explodes while worker pay flatlines. Shareholder returns skyrocket while worker share of GDP drops. Buybacks are a wealth transfer mechanism from labor to capital. Problem 3. Short-termism. Executives compensated with stock options focus on short-term stock price. Buybacks boost stock price immediately. R&D takes years to pay off. Wage increases reduce short-term profits, so executives choose buybacks. Get rich quick. Leave the company before long-term consequences hit. This creates culture of short-term thinking. Cut R&D to fund buybacks. Cut wages to fund buybacks. Cut quality to fund buybacks. Cut safety to fund buybacks. Everything sacrificed for quarterly stock price. Problem 4. Financial fragility. Many companies borrow money to fund buybacks, going into debt to inflate stock price. This creates vulnerability. When crisis hits like 2020 pandemic, over-leveraged companies collapse. And who bails them out? Taxpayers. Through government rescue packages. So companies use debt for buybacks. Executives get rich. Companies fail. Taxpayers bail them out. Privatize profits. Socialize losses. The American way. But here's what's most disturbing. This is all legal. Encouraged even. Because the people making the rules benefit from the system. Let's talk about who benefits and who loses from buybacks. Winners, CEOs, and executives. Stock options make them rich. The more buybacks, the richer they get. Average CEO in S&P 500 makes $15 to $20 million annually, mostly from stock options that benefit from buybacks. Activist investors, hedge funds that buy stock and demand buybacks. They profit when stock price rises from buybacks, then sell. Financial industry, investment banks advise on buybacks. Get fees. Traders profit from increased volume. Wall Street makes billions facilitating buybacks. Wealthy shareholders, top 10% own 89% of stocks. They benefit enormously from buyback-inflated prices. Losers, workers get nothing from buybacks. Their wages stagnate while company profits go to stock manipulation. Since 1980, productivity increased 70%. Worker wages increased 12%. The gap went to shareholders through buybacks and dividends. Long-term investors, buybacks create artificial prices that eventually correct. When correction happens, long-term investors lose. The economy, $7 plus trillion spent on buybacks since 2009, is $7 plus trillion not invested in growth, innovation, or jobs. Small businesses can't compete with large corporations that manipulate stock prices. Level playing field destroyed. Society, inequality, financial fragility, short-termism, all harm social cohesion and economic stability. The system is rigged, and it's perfectly legal. But some countries recognized this and banned buybacks. Let's see what happened. France heavily restricts buybacks. Companies must prove buybacks serve legitimate corporate purpose. Result: French companies invest more in R&D and workers. Less inequality. More sustainable growth. Japan historically banned buybacks until 1990s. When allowed them, economic problems accelerated. South Korea restricts buybacks. Requires government approval. Result: higher corporate investment rates. Less financialization. These countries prove you can have stock markets without buyback manipulation. But in America, buybacks are not just legal but celebrated. Why? Because the people making the rules benefit from them. Congress members own stocks. Their wealth increases from buyback-inflated prices. SEC officials often come from and return to financial industry. Revolving door. Media financial coverage is sponsored by companies doing buybacks. The system protects itself, but there's growing pushback. Because buybacks are becoming impossible to ignore, something remarkable happens. Progressives and some conservatives agree on something. Buybacks are a problem. Bernie Sanders and Marco Rubio, opposite political spectrum, both propose restricting buybacks. Why? Because the damage is becoming undeniable. The evidence. Study by Harvard Business School. 60% of S&P 500 companies spend more on buybacks than on R&D. Study by Federal Reserve. Buybacks are a major driver of inequality. Wealth concentrates among top 10% who own stocks. Study by Roosevelt Institute. Companies doing buybacks pay workers less and invest less in growth. Study by SEC. Many buybacks are timed around executive stock option vesting. Clear evidence of self-dealing. The academic evidence is overwhelming. Buybacks harm the economy and enrich executives. But changing the rules is hard. Because Obstacle 1. Corporate lobbying companies spend hundreds of millions lobbying to keep buybacks legal. They fund think tanks that produce pro-buyback research. They donate to politicians who support buybacks. Obstacle 2. Wall Street opposition. Financial industry makes billions from buybacks. They'll fight any restrictions aggressively. Obstacle 3. Ideological resistance. Free market fundamentalists claim any regulation is bad. Let companies do what they want with their money. But this ignores that buybacks are only legal because of government regulation. 1982 rule change. Changing rules isn't intervention. It's different intervention. Obstacle 4. Complexity. Most people don't understand buybacks. Company buying its own stock sounds harmless. The manipulation is subtle, hard to explain. So despite evidence, change is slow. But some solutions are proposed. Solution 1. Ban buybacks. Make them illegal again like pre-1982. Force companies to invest in real things. Problem: too radical, won't pass. Solution 2. Tax buybacks. 2022. Congress passes 1% excise tax on buybacks. Small but symbolic. Proposal: increase tax to 4 to 8%. Make buybacks expensive enough that companies choose investment instead. Solution 3. Restrict executive compensation limit. Stock-based pay. Require longer vesting periods. Ban executives from selling stock for years after buybacks. This breaks incentive to manipulate stock price. Solution 4. Require investment minimums. Force companies to invest certain percentage in R&D and worker wages before allowing buybacks. Solution 5. Disclosure and transparency. Require companies to disclose buyback timing relative to executive compensation. Make manipulation visible. Any of these would help. But implementing them requires political will that doesn't exist yet, because the people in power benefit from the current system. So here's what stock buybacks really are. Legal market manipulation that enriches executives while harming everyone else. Until 1982, buybacks were considered fraud. Then Reagan changed the rules. And what followed was the greatest wealth transfer in American history. $7 trillion spent on buybacks since 2009. Money that could have funded innovation, raised wages, created jobs, or strengthened companies. Instead, it inflated stock prices, made executives rich, created illusion of growth while real economies stagnated. The results are clear. CEO pay increased 1,000%, plus worker wages stagnated, inequality exploded, R&D spending declined as percent of revenue. Companies became financially fragile, short-term thinking dominates. Market disconnected from economic reality. This isn't conspiracy. It's documented fact. Academic research proves it. Data confirms it. Even some politicians acknowledge it. But the system continues because the winners controlled the rules. Every time you hear stock market hit new high, ask, is this real growth or buyback manipulation? Most of the time, it's buybacks. Companies spending billions to inflate their own stock prices. The market isn't measuring economic health. It's measuring how much companies are willing to spend, manipulating their stock prices. This is the quiet rigging of American capitalism. Not dramatic conspiracy. Just regulatory capture and legal manipulation. And it's destroying the economy while enriching a tiny elite. What do you think? Should buybacks be banned or more heavily restricted? Is stock-based CEO pay the problem? Drop your thoughts in comments. Because right now, companies are spending $800 billion annually on buybacks instead of investing in workers and innovation. Your wages aren't growing because that money is going to stock manipulation. Your company isn't innovating because that money is going to stock manipulation. The economy isn't growing sustainably because capital is being wasted on financial games instead of real investment. But the stock market keeps rising, and CEOs keep getting richer. Because the game is rigged. Quietly, legally, profitably for them. Stock buybacks aren't investment. They're extraction. Taking value from the future to inflate prices today. And everyone's acting like it's normal. Like it's capitalism working. But it's not capitalism. It's financial manipulation disguised as corporate governance. The market is rigged. Just not how you think. No shadowy conspiracy. No illegal trading. Just executives using company money to manipulate stock prices and enrich themselves. All perfectly legal. Thanks to one rule change in 1982. That's how you quietly rig a market. Change the rules. Make manipulation legal. Call it shareholder value, and watch as trillions flow from workers to executives while everyone pretends the market is measuring real economic performance. Welcome to buyback capitalism, where stock prices rise while the real economy dies. And the CEOs laugh all the way to the bank.